So Oxford Technology was founded in 1983, and we've been making science and technology investments since 1983. Over 200 investments to date. And in 2012, the SEIS scheme was introduced, and we realized it was absolutely perfect for what we do, which is backing early stage science and technology companies, of which we see many. We see around 1,000 things that might be investable, probably 200 more reasonably investable for us. We'll look closely at about 60 and then make an investment in 6. That's a year. That's what we've been doing the last 10 years or so, and it's been going rather well. An example of things that we've invested in the past, Gnox was in the news a little while ago for its 1.5 billion cash exit to Terumo of Japan. It's a machine that allows livers to be looked after awaiting a transplant, and this means that surgery can happen at a sensible time of day. The surgeon can be certain the liver is in optimal condition before it's transplanted. It started off with academics who had an idea of how they wanted to do it, and we backed them. And that's as early as we go in, right at the start. We have 2 funds. One is the OT SEIS fund, where we invest money over a 3-year period. Doesn't mean you get it back after 3 years. It means we split it, and then the first chunk in the first year is invested under SEIS, so with the increased tax break mentioned before, and we then follow on in the companies that desire and deserve more funding with typically with EIS, although sometimes now the second round of investment is also SEIS. And the aim is to maximize the long-term returns, not the tax break or the timing of the tax breaks. And you'll see that those long-term returns are worth waiting for. The second fund we have is an approved fund, which means that it can be the tax break is backdated to the date that the fund starts. We have one of those every quarter. They're EIS only, so they don't have the SEIS tax break. We invest in 5 companies from our portfolio that we are at an advanced stage, usually selling or getting very close to commercialization. The next round will be opening in March. We're just waiting for the HMRC's approval, and will close just before the end of the tax year so that the tax relief can be claimed in this tax year, or in fact even in the preceding tax year should that be necessary. Anyone who's left it a bit late, very good. So here we're backing companies that have a shorter time to exit compared to the SEIS companies. The tax reliefs have been covered, so I won't go into those again at this point, but they're very generous and they allow us to take the high upside risks that we do. This is a full view of our portfolio. We're not going to go through it all now. You'll be relieved to hear. But if you go onto our website, you can download our quarterly report. It has the full portfolio. It has a full history of every investment we've made, including all the ones that have failed, and of which there are about 10% or so, 10, 12% of the things have failed. On the right, you can see the way in which the returns come. There's a portion, the green portion is the tax relief, red is cash back, and then the yellow and orange are cash due and fair value of milestones. Sometimes when we sell a company, there's still money coming in over a period of time, potential further milestones, which we would need a taller screen to get it in, because one of our investment has very high potential further milestones. Just to give you a sense of the companies we invest in, Refine was a spin out from Oxford who developed a device which was over 1 billion times more sensitive than the next best device, and that allowed them to enter the market quickly and grow. Their share price went from 63p when we invested to £5 a share now. There was a big investment from a US VC, and they're looking to make their return on the upside from £5. So we think this might end up in a very good position for us. More recent investment is Metacarpal. They developed very lightweight and flexible prosthetic hand. People who've used robotic hands say this makes a world of difference because of the responsiveness and the ease of use, and because it's light and they don't have to lug a heavy thing around the whole time. That started to make very good sales in the US. We invested just well, I guess it's almost 2 years ago now. Time flies. But we expect that share price to go up once the sales kick in really well. And a third example, this is what kind of technology I love. It could have been done 30 or 40 years ago, but no one spotted the opportunity. The founder of this company understood that people who've had accidents or trauma, such as on a battlefield, tend to get hypothermia. And also when they have to be moved off their stretchers to have x-rays to find out what's broken. And you can understand that's a really bad idea. So they've developed a stretcher which is x-ray transparent and provides built-in warming. So patient is comfortable, well, as comfortable as they could be, to all the way to the hospital, into the x-ray machine, and then they can be moved once they know exactly what's wrong. And these are the kind of things that there isn't such a device, and the interest from the US military in particular is great. Another reason we like this company is we knew that it didn't have to go through medical approvals in the US. There's an exemption which allows stretchers to be put straight through, and that really speeds up. And over time, you learn what it is that can hold companies up. To give you an idea of what a portfolio might look like for an investor, if you advise someone or if they choose to take it up. In 2014, I invested £15,000 into the fund. It ended up being invested over 10 companies, the first 6, and then there were SEIS, and then there was some money left over at the end. So that went into a couple other SEIS investments, and a few of the companies are doing very well. One has done very well and has exited. And I'll tell you a little more about that next. So Ducentis they developed a new kind of drug. We spotted them at a presentation. It was an Innovate presentation, and we were the only investors in the room who decided to speak to Ducentis. We found their approach, even though they had no data yet, it was very clear that their idea was sound. We gave them the first money to do the first experiments to show that what they were planning on doing would work, and it did. We gave them another 50 after that, which allowed them to get to the point where other investors then joined in. We'd invested at a share price of 14 to begin with, and others invested then at 36p. And after a while, they were bought out. And as you can see, my investment from the £15,000, £4,000 went into Ducentis. That's already provided a £49,000 cash return to date. We're expecting in Q1 of this year over another £14,000 to come in. And if everything is successful, as we hope it will be, there will be up to $500,000 in milestones and royalties going forward. So the return from that is very attractive. And it's been a strong driver for people in various years of the portfolio. But as you can see, over the years, this is people who've invested in portfolios in different years. The X, as I'm indicating here, is how much they've invested, and this is what their portfolio is worth now. The newer companies haven't had time really to grow in value yet, but that will come because some of those companies are starting to do very nicely. Just a quick reminder of the two opportunities. We have the SEIS fund, investment spread over 3 years, although we take all the money up front. We invest over a 3-year period. The track record shows it works. It's high risk. It is very long-term and illiquid, but as a part of a portfolio, it can mean that you end up with a good return over the longer term. And the other one is the OTKI fund, where we invest rapidly. The tax break comes in right at the front. We invest you get the tax break on the entirety of the investment, whereas the SEIS, the fees don't get the EIS tax relief. And the next one of these will open in March and close at the end of the tax year. That's what I have to say. Thank you very much.
Hi, Andrea. Thank you for that. Very, very, very informative. Got a couple of questions that have come in. Obviously, with the VCT, you're invested into a more established portfolio. You've talked about some of the historic investments you made in the EIS. Anyone going in now? Have you got some insight into what they could be going into?
Well, if someone were to join the OTKI fund, they would be going into a company that makes use of AI to improve MRI diagnosis of prostate cancer. They have already got good sales, over 2 million, a contract for over 2 million from the NHS, and they will be going into a company that is has a technology which increases the growth rate of plants by about 10 to 15%, which is a massive improvement in the margin for agriculture, and also a company that helps detect risk of falls for patients in the US. And if under SEIS, one of the investments would be, and I'm very excited about this, a battery technology which fits in perfectly with all existing battery technology, but provides a 30% uplift in performance. And we think that's going to really move the dial UK.
Excellent. And then I guess one thing in EIS space, again, it's difficult to see performance and do relative performance against other funds. How does Oxford Technologies stack against the other EIS, SEIS fund managers?
Well, it's difficult to tell because they tend not to be quite as transparent as to what's going on. We're very transparent and we know the results. The returns, as you've seen, are good and promising for those who are there. We have quite a number of investors who say, yeah, we've decided to come with you because we can see what you're doing and we really like it. It's clear for us to see. We can see how it works. We can see it takes time, but we can see it provides good returns.
Excellent. And then last one I've got, obviously you've mentioned there you've got the combined SEIS and EIS fund and the knowledge intensive fund. Do you see a different type of investor going into the two different funds?
Yes, when people have left it a bit late, they will go into the OTKI fund, and if they're long-term planners, they go into the OTSEIS fund. But both of them are,
I should say that lots of people go into both of them.
yes, quite.
Interesting. Excellent. Okay, that's all the questions I've got. So, Brian, have you got anything?
No, I think we'll move on. Big thanks to Andrea and Lucius. I've known both of these people for a long time, and it's quite interesting to speak to someone who has been invested in this industry for such a long time. I think that gives a very interesting perspective on what goes on. So I always enjoy chatting with Andrea and Lucius. And if you ever want to find out more, we've interviewed both of them on the EIS Navigator podcast, so you can go and find those episodes.